Welcome to Course 05 of the MaxLife Commercial Academy, Building CRE Pro Formas in Excel. I'm Ryan Solberg, real estate broker with MaxLife Realty LLC here in Central Florida. In this course, you are going to learn how to build a complete commercial real estate financial model from a completely blank spreadsheet. No templates to start with, no shortcuts, just a clean sheet and a disciplined structure that will let you underwrite any deal with confidence. Whether you are analyzing a strip center, an industrial building, or a NNN investment, the pro forma framework we cover here is the same one that institutional investors use every day. By the end of this course, you will be able to model revenue, expenses, financing, and returns, and then stress test every assumption with sensitivity tables. Let's get started. The first thing we need to do before we type a single number is understand the architecture of a professional pro forma. Every well-built model has exactly three zones: inputs, calculations, and outputs. The input section is where every assumption lives: your purchase price, your loan-to-value ratio, your interest rate, your rent roll by tenant, your projected vacancy rate, your operating expense line items, and your assumed exit cap rate at the end of your hold period. Nothing in the input section should ever contain a formula. It is purely a data entry zone. The calculations section is where Excel does the work. This is where you compute effective gross income by applying vacancy to potential gross income, where you subtract operating expenses to get NOI, and where you subtract debt service to get before tax cash flow. The output section is the scoreboard: IRR, equity multiple, NPV, and cash on cash return displayed cleanly so any investor can read the results in 30 seconds. A simple but powerful discipline. Color code your cells. Use blue fills for every input cell and leave formula cells white. This makes it immediately obvious which numbers a user should touch and which ones they should never override. Finally, keep all of your assumptions on a single dedicated tab. Every formula in your revenue sheet, your expense sheet, and your return sheet should reference that one assumptions tab. When you need to change a cap rate or an interest rate, you change it in one place and the entire model updates instantly. Now let's build the revenue side of the model. Start your rent roll with a simple table. Tenant name in column A, rentable square feet in column B, rent per square foot in column C, and annual base rent, which is just B times C, in column D. Sum column D, and you have your potential gross income for year one. From there, you need to project rent forward through your entire hold period, which is typically 5 or 10 years for a CRE acquisition. For each tenant, apply the rent escalation structure from their lease. If it is a triple net lease with 2% annual bumps, you write a formula that multiplies the prior year rent by 1.02. If the lease is fixed dollar steps, say rent jumps from $18 to $20 per foot in year 3, you model that as an IF statement that switches values at the right year. Once you have PGI projected year by year, you apply your vacancy and credit loss assumption. This is a blended factor that accounts for the risk that some space will be vacant between tenants and some tenants will be slow to pay. For stabilized, well-leased assets, 5% is a reasonable starting point. For value add or lease-up situations, you might model 15 to 20% in the early years, trending down as the asset stabilizes. Subtract vacancy from PGI to get effective gross income. Then add any other income: parking, signage, KM reimbursements, and you have a complete revenue projection ready to feed into your expense model. Operating expenses are where a lot of buyers get burned because sellers have a strong incentive to understate them, and buyers often use a quick rule of thumb, a flat 30 or 40% expense ratio, instead of building a real line by line model. Here is the discipline we follow at MaxLife Commercial. Start with property taxes. In Florida, when a property sells, the county often reassesses it at or near the sale price. If the seller has owned the property for a decade, their tax bill may be far below what you will actually pay after closing. Pull the county property appraiser data and model taxes based on the new assessed value, not the trailing actuals. Insurance is the next line. In Florida especially, insurance costs have risen dramatically in recent years. Get an actual quote from an insurer rather than relying on the seller's current policy costs. Property management is typically 3 to 5% of effective gross income if you are using a third-party manager, or you can model it at cost if you are managing in-house. But always model it because it is a real economic cost even if you are doing it yourself. Repairs and maintenance should be modeled at somewhere between 50 cents and $1.50 per square foot depending on asset age and type. Model capital expenditures as a separate reserve line below the NOI line so you can see their impact on cash flow without distorting your NOI and cap rate calculations. For each line, assign a specific annual growth rate in your Inputs tab. When you run sensitivity analysis later, you can stress individual expense lines to see which ones have the biggest impact on your returns. The loan amortization schedule is the part of the model that most beginners skip or oversimplify, and it is also the part that catches the most surprises at closing. Here is how to build it correctly. Start with 4 inputs in your Assumptions tab. Loan amount, annual interest rate, amortization period in months, and loan term in months. If the loan has an interest-only period, which is common on bridge and value-add acquisitions, you need to model that separately before the amortizing portion begins. During the IO period, your monthly payment is simply the loan balance multiplied by the annual interest rate divided by 12. No principal is being paid down. Once the IO period ends and amortization begins, use Excel's built-in PMT function. The syntax is PMT of rate per period, number of periods, and negative loan balance. This gives you a fixed monthly payment. From there, build a full monthly table, opening balance, monthly interest, monthly principal, and closing balance. The monthly interest is the opening balance times the monthly rate. The monthly principal is the total payment minus the interest. The closing balance is opening balance minus principal paid. Run this table out to the loan maturity date. The closing balance on the last row is your balloon payment, the lump sum due when the loan matures. In your annual model, sum 12 months of debt service for each year. Then calculate DSCR, debt service coverage ratio, by dividing annual NOI by annual debt service. Most commercial lenders require a minimum DSCR of 1.25 times. If your model shows DSCR dropping below that level in any year, flag it. That is a deal structure problem you need to solve before you go to a lender. The return section is the scoreboard of your pro forma. It translates all of your cash flow projections into the metrics that investors and lenders actually use to make decisions. Let's build each one. Cash on cash return is the simplest. For each year of your hold, divide the before tax cash flow by the total equity you invested at closing. If you put in $500,000 of equity and the property generates $40,000 of after-debt service cash flow in year one, your cash-on-cash return is 8%. This tells you what you are earning on your cash right now, independent of appreciation. The internal rate of return is the most important metric for comparing deals with different hold periods and different cash flow profiles. In Excel, set up a column with your initial equity investment as a negative number because it is money going out, followed by each year's before tax cash flow. And then in the final year, add the net sale proceeds to that year's cash flow. Apply the IRR function to that entire column. A levered IRR between 12 and 18% is a reasonable target for most CRE acquisitions, though NNN deals often trade at lower IRRs because of their lower risk. The equity multiple is simply total money returned divided by total money invested. If you put in $500,000 and get back $1.2 million over 5 years, your equity multiple is 2.4 times. And finally, NPV, net present value, tells you in today's dollars how much value the deal creates above your required rate of return. A positive NPV means the deal exceeds your hurdle rate. These four metrics together give you a complete picture of deal performance. A single scenario pro forma is not a model. It is a story. Real underwriting requires stress testing every major assumption and understanding which variables have the most leverage over your returns. That is what sensitivity tables and tornado charts do. Let's start with a two variable sensitivity table. Go to Excel's data menu, choose What If Analysis, then Data Table. In the corner cell of your grid, enter a reference to your IRR output. Put your range of exit cap rates along the top row and your range of rent growth assumptions down the left column. Excel will populate every cell in the grid with the IRR that results from that combination. Use conditional formatting to color the grid. Green for IRRs above your hurdle rate, yellow for borderline, red for below. This gives an investor an immediate visual understanding of the deal's risk profile. A tornado chart takes this one step further by ranking every input assumption by its individual impact on your IRR. You test each assumption independently, holding everything else constant, and measure how much IRR moves when you go from a pessimistic to an optimistic value for that variable. The assumption with the widest swing goes at the top of the chart. That is your biggest risk factor. For most CRE deals, exit cap rate and rent growth are the top two risks. Loan interest rate is usually third. Knowing this tells you where to spend your diligence time and where to build in the most conservatism. At MaxLife Commercial, we never present a deal to an investor with a single scenario. We always show base case, upside, and downside. And the sensitivity tables make the assumptions behind each scenario completely transparent. And that wraps up Course 05, Building CRE Pro Formas in Excel. You now have the complete framework to model any commercial real estate deal from a blank spreadsheet. You can structure your inputs, project revenue with realistic escalations and vacancy assumptions, build a line-by-line expense model, construct a full loan amortization schedule, calculate IRR, equity multiple, NPV, and cash-on-cash returns, and stress test every assumption with sensitivity tables. This is the skill that separates serious CRE investors from people who rely on a seller's underwriting. When you can build your own model, you control the story. I'm Ryan Solberg, broker with MaxLife Realty LLC here in Central Florida. If you have questions about a deal you're analyzing, or you'd like to talk through an acquisition in the Central Florida market, give us a call at 321-586-2121 or visit us at maxlifedevelopment.com academy to continue your education. The next course in the academy is Market and Submarket Analysis, where we dig into how to read market data and identify the submarkets that are positioned for the strongest rent growth and cap rate compression. See you there.